Okay, so I'm Leslie Sultan. I'm an estate planning attorney. I'm also a working mom with 2 kids. I've been practicing law since 2009. I founded my business in 2010, and I'm also the host of the estate planning podcast, Legacy Purse. That's on all podcast platforms. So if you're interested in learning more about estate planning, each episode is an interview with a different person in a special area of estate planning. So I think it's great. I'll check it out, and hopefully you can learn more in that way. So we're talking about legacy, what that means. And of course, we want to start with what estate planning is. So it basically means having a plan that establishes who will receive your assets and who will carry out your wishes when you become incapacitated or after you die. The basic documents are advanced healthcare directives. We recommend that everybody, the minute you turn 18, that's when you formally are an adult. That's when you are an independent, autonomous individual, and only you can make decisions for yourself. So at the very minimum, we want everybody to have advanced healthcare directives. So that includes a living will, which is giving wishes for medical treatment, particularly if you're in a vegetative state. A healthcare proxy, where you appoint a trusted agent to make medical decisions for you. Don't assume that just because you're married or because you have your parents, that those people can be those trusted people. It's best to nominate somebody through the healthcare proxy. And then there's HIPAA forms, which are release of medical information for your loved ones. If they have the information, they can make better decisions. And lastly is power of attorney. Power of attorney is a legal document that enables another person to represent or act on another's behalf in financial, business, and other legal matters. Power of attorney is a very important document with estate planning. When we use it most is for when someone becomes incapacitated and they're not able to sign their checks or make banking decisions. Usually we see these with parents who are starting to have Alzheimer's or dementia, and someone needs to act in their best interest. If this power of attorney document is not done, a formal legal proceeding called a guardianship has to be done to appoint somebody. So it's really simple and easy to do a power of attorney, appoint the person you trust, and make sure you can stay out of court. Power of attorney can also be used if someone's out of country or out of state and you need someone to execute documents on your behalf. And if you're physically incapacitated, so not just mentally, but you're in a hospital, your leg's in one of those strapped up things, and you can't come to, real estate purchase or real estate sale, you can appoint somebody to sign on your behalf. And as we discussed, it's for mental incapacitations as well. So the other thing that we want to talk about with legacy planning is what could go wrong. So the first thing that could go wrong is you could wind up in probate court. So what is probate? Probate is the court process required to distribute or take control over someone's assets after they die, with or without a will. If you don't have a will, your estate goes through what we call an administration process, but it's essentially very similar, same process. So the question, especially in New York, is how long does probate take? And unfortunately, it takes a very long time in New York. So depending on the value of the estate, if it's anywhere, it could be only a few weeks. If it's a small estate, meaning less than 50,000, that's called a small estate in New York. And that can generally be take a few weeks. But anything $50,001 means it's a full-on probate. And we have cases that take years. Unfortunately, the courts are very backed up ever since COVID. It's a problem. And during that time, the estate is affected, the family is affected, and there's costs. So the cost of probate can be enormous. Most attorneys charge an hourly rate. You can see some range from $450 to $800 an hour. So costs to the family of the deceased person can easily exceed over $10,000. And if there's substantial assets, we've seen estates, and we can hear about celebrities where there's millions of dollars in legal fees paid out. What we see a lot too in the estate planning community is that some family members don't have access to the money, and so they cannot afford to pay an attorney. And so they work out an agreement with the attorney for the attorney to take a percentage of the estate. So for example, if let's say we're talking about a 5% sort of commission deal and the assets are worth $1 million, there's a house and a couple bank accounts. that would mean that the attorney is entitled to $50,000. So, you know, your parent or your loved one who worked hard to establish that wealth, now a big chunk just goes straight out to the attorneys. Probably not what they intended. We've also seen where there's a risk and an attorney might not want to take on the case. If there's no fees, they'll take a contingency up to 33%, which is, you know, a huge amount. So the cost of probate can be very unfortunate for family members. So most people know what a will is. It's instructions for how you want your assets to be distributed when you die. So the big question is, if I have a will, can I avoid probate? But the answer is no. As I mentioned before, probate is for wills. And if you don't have a will, there's another process called an administration. The bottom line is a will has to be verified and acknowledged by the judge. You cannot take the will to the bank and say, hey, I just inherited this money from my loved one. Please give me my money. The bank is going to have no way to verify if that will was actually not, you know, is true. It wasn't just drafted in your kitchen. They have no way of knowing a lot of things. So it has to go through the courts. The courts will issue letters of testamentary or letters of administration, and that will give the bank the authority to distribute the assets. So until that time, unfortunately, everything gets frozen. No assets can be transferred. If you're a homeowner, for example, and you are trying to collect rents from your tenants, technically you have no legal authority to collect those rents. No expenses can be reimbursed, those funeral bills. If there's a co-op or a mortgage and you're paying maintenance or a mortgage, those fees have to come from the family until that probate is resolved and the money can be accessed. So it can be very painful for the family to go through this probate process and not have access to their loved ones' assets. And unfortunately, even after someone's appointed, depending on circumstances, the judge might have to approve any transfers or any distributions. So it's not the best way to do things. I do like to mention, because we do have a lot of property owners that come to these webinars. So again, what does it mean if you own a house and you're now in probate? So again, the property cannot be sold without court approval. The family members have no authority to collect rents from the tenants until they're appointed by the court. In some instances, the court will appoint a non-family member as a receiver. That person can collect the rent, but that person also receives a fee for their job. So again, more wasting of the assets to non-family members. The property cannot be financed. We see a lot of situations where a house that was meant to go to family winds up in foreclosure because the family's not able to pay, they have no access to the money, and now the value is substantially decreasing. So probate can be quite a burden on the families. So of course, the next question is, how can I avoid probate? So the idea is a trust. A trust is basically a tool that we use. It's the same. You can create a trust and distribute your assets just like a will and specify how you want it to be done. The beauty of a trust is that the trust now will own the property. So for example, if you have a house, you would transfer the deed into the house. Your bank accounts could be retitled into the name of the trust. I think I misspoke a minute ago. The beauty of a trust is that you maintain control over the trust if it's a revocable living trust, because you're the initial trustee. So you create the trust, you're the trustee, you own the house, you can refinance the house, you can collect rents from the tenants, you can pay your bills using trust money. It's all in your control. The beauty then is that once you pass away, if you've created this trust, your successor trustees, the people you've named to take over, automatically, without the need of probate, automatically take over the control of all those assets. It's a seamless process that couldn't have been, it was very well crafted to create a trust. The new trustees do not need any authority from a court to maintain the trust, to collect rent, pay bills, refinance, etc. A lot of people are overwhelmed by the word trust. I'm not quite sure what it means. So just so that we get through the legal definition, it's a legally binding written agreement between the creator of the trust, known as the grantor, and the trustee, which is often yourself. And the trust provides legal protection for all of the assets that you put into it, and then they're distributed according to your wishes without judicial intervention. So one way to look at the analogy of a trust is it's like this red wagon. So this girl has put all of her toys, her valuable legacy into the wagon. And as long as they're in the wagon, she's controlling it. She pulls the handle. She can take things out. She can put things in. And there's no probate court. Once she passes away, the next person just grabs that handle, and they now have access to all of those assets, those toys. What would happen though with sometimes what we see with trust funding is you don't put your assets into the trust. If they don't make it into the trust, they do have to go through probate, which then winds us back into court and invites conflict. So one of the most important things about planning a trust is that you work closely with an estate planning attorney to make sure that you're funding it properly. One of the biggest reasons why we don't recommend people do trust planning through, LegalZoom or an online system. I do want to mention estate planning for minor children, because parents of minor children are technically very vulnerable when it comes to estate planning, because we want to do planning. We want our children to inherit our assets. That's the part of the legacy. We're trying to create generational wealth, generational distributions of our assets. And some of us have minor children, and we don't think about the fact that minors cannot legally inherit. So it becomes a big problem in that when we go through probate or any other administration, if a minor is inheriting, there has to be a whole separate process for somebody to be appointed for the assets, the inheritance of that minor. I had a case where a woman came to me to tell me she did a trust. Her child inherited money through life insurance from the grandmother, and the child was 14 when the grandmother passed away. So the mother had to go through the court process of getting appointed to be the guardian of the money for the child. And unfortunately, the judge appointed her, but said you have to put all the money into a conservative, non-interest bearing savings account to protect it. So for all those people who are here in financial planning and know about investing and growing your wealth, this sat there for 4 years until the child became 18. And when he became 18, he didn't just get the money. His mother had to petition for it to be released to him. So it's a whole process. She spent thousands of dollars just of her money helping her son get his inheritance. So again, one thing we want to do for estate planning, and we have minor children, is setting up a trust. So for example, KIVA is going to talk about life insurance. Life insurance, a lot of people put children as the beneficiary. Of course, they want their children to receive that money, but again, children cannot inherit. But if you've set up a trust, the trust can inherit the money. The check's written to the trust. The successor trustee will have access to that, and that's somebody that you've appointed. And within your trust, you can specify how you want the money distributed. The beauty of a trust is it can have sub-trusts. So instead of the children inheriting it at 18, and some people might not like the idea of a child inheriting a potential $1 million life insurance benefit at 18, so you can hold the money in trust for them until they reach a certain age or stage, like graduating college or getting a master's degree. The other really powerful benefit of estate planning when you have minor children is you can name guardians. So who would raise your children if something were to happen to you and their other parent? So nobody likes to think about those things, but it's really important to do estate planning to name guardians for minors so that random family members aren't coming out of the woodworks trying to raise your children and potentially get access to their inheritance. So as a quick overview, when you do set up an estate plan, we also encourage people to revisit their plan every few years. And so I'm going to give you 5 reasons to revisit or update your estate plan. So number 1 is if you have a new family member, a child, in the event of a marriage or divorce, if you buy a new house or acquire a new property or have an inheritance, when your beneficiaries change. So you decide you don't want someone to inherit anymore, or maybe the beneficiary passed away. And of course, if you move to another state. So I like to use celebrities as an example for estate planning because we can all relate. So the first one I want to talk about, or the only one I have time to talk about today, is Whitney Houston. As many of you know, Whitney Houston was married to Bobby Brown. She's the queen of pop, I think it is. I love Whitney Houston. Anyways, she and Bobby Brown had one child together, Bobby Christina. Whitney Houston did estate planning. She did a will, and in her will, she said she wanted everything to go in trust to her daughter. So this is called a testamentary trust. It's not my preference, but that's how she did it. And then in the trust, she said, I want money to go to my daughter, Bobby. I want a third of it to go out at 18, another third to go out at 25, and another third to go out at 30. So she created a breakdown of how often the distributions are set up for Bobby Christina. As many of you know, unfortunately, Bobby Christina died at age 20, the same fatal death as her mother. And Bobby Christina had not done any estate planning, unfortunately. So who do you think inherited the first portion of the money that Bobby Christina got? So she's lived in California. Under the laws of California, it went to her next of kin, which was her father, Bobby Brown. So essentially a huge chunk of Whitney's assets went to her ex-husband, Bobby Brown, which I'm sure was not what she wanted. Fortunately, as I mentioned, there were the other two distributions that didn't happen. And so Whitney Houston did have language that says, if my daughter passes away, I want that money to go to my sisters. So she was able to, preserve the legacy, so to speak, and have it go to her sisters instead of all of it going to Bobby Brown. Had she not done estate planning, unfortunately, that's what would have happened. So that's my estate planning presentation. I'm going to skip over now to KIVA and introduce her so she can do her presentation on how you can help develop your wealth and leave a great legacy for your children. So, and your heirs or loved ones. So
Okay.
KIVA Waters is a fellow CUNY alumni, and she is a life insurance broker. She's also the co-founder of Happy Life Insurance. She's also an author, a yogi, and a seasoned New York bankruptcy lawyer. And she has a keen interest in serving underrepresented communities. And I think I'm super happy to be here with her and present with her. She's great with numbers. She's seen a lot of people not make some right financial decisions in her bankruptcy practice. So she's really equipped to help a lot of people with their planning. So go ahead.
Hi, guys. Hear me?
Yes.
Good. Thank you, Leslie. That was really, really helpful and informative for my purposes. I have a huge family, and we need lots of trust funds coming down the pipeline. So we are going to be doing a lot of work together in the future. As Leslie said, I'm a bankruptcy lawyer by trade. I'm a yogi in my heart, and I'm a New York State licensed life insurance broker ever since the pandemic. So what I know in my head and in my heart is that money is not the root of all evil. It's 2023, and it's time to debunk that myth. Money is actually a useful tool to help ourselves and to help other people. When you think about buying life insurance, you should be thinking of it as making your money as useful as you possibly can in a positive way. You should be thinking about making your money work for you, and you should be thinking about finding and buying policies that meet your needs and your budget. Right? Most people are just picking based on what they can afford, but they forgot about what the policy is supposed to be doing. It's supposed to be making your money work for you. And yes, I said policies, plural. Contrary to popular belief, you need a combination of life insurance policies to really protect yourself, protect your loved ones, and protect your legacy. So let's start with the basics. Term life insurance is probably the most familiar and straightforward, right? Maybe because it's the cheapest, I don't know, right? But everybody I talk to, they usually know what term life insurance is about. They basically know that it covers them for a specific period of time, and they know that their beneficiary will receive a death benefit if they pass away during the period where the term policy is in effect. The death benefit is probably going to cover your funeral costs, and it might pay a few bills, but the term ends at the end of the term. So even if you die, if you die before the term, you're covered. If you die after your term ends, then you don't have any coverage. This type of insurance is basic, but it does work when you have young children and they're depending on you, right? But what if you want lifelong coverage and you want a little something extra too? That's where the whole life comes in. And there's a bunch of people that know or have heard of whole life insurance as well. It's also called permanent life, and it costs more money to buy than term. Why? Well, whole life has a death and a life benefit attached to it. So whole life insurance policies have a savings component that accumulates cash value over time. And the cash value, most people know they could borrow against it, and they can use it actually to pay the premium on the policy that they're building the cash value on. Like I said, a lot of people know about term and they know about whole, but what they don't know is that they need both of these and maybe even more, right? As part of your plan to secure a real legacy. So let me tell you some other things you may not know about term and whole before we move on. Term life insurance guarantees your future insurability. What? Yeah, I know. It kind of threw me the first time I heard that too. So don't worry if it's throwing you. But what that means is that owning a term policy guarantees that you are eligible to purchase more policies in the future, right? Whole life insurance does not guarantee future insurability. This means you could buy a whole policy now and then not be allowed to buy more policies later on. But if you have a term policy in place, you can buy another term, you can buy another whole, regardless of any conditions that might changed in your life. Like maybe your medical is not so good later on. You still have the right to buy more policies as long as you have a term policy in effect. That is not the case with a whole policy. So they both have benefits, and they actually have benefits that we don't even know about. Also, the whole life insurance adds to your net worth while you're alive. Term does not, right? What that means is if I have a term policy for 100,000 and I add a whole policy to that for 500,000, my net worth just increased by $500,000, not by 600, because the term policy is not adding to your net value. So they both have really good benefits, and that's why I know now that life insurance is a combo pack. That's what I like to call it. It's a combo pack. It's not a matter of choosing one or the other. You need to cover yourself thoroughly so that everything is secured. That's what it's about. We're talking about legacy, right? So let's talk job insurance, because a lot of times I talk to people about insurance. The first thing they say is, oh, my job have insurance for me. Maybe you have a policy through your job, and that is good. But in the big scheme of things, your job insurance, if you have it, right, is a joke. Sorry, not sorry. Okay? So job insurance is very limited in its ability to build a legacy for you. Why? Because job insurance is only term, right? Number one, term is not bad. We just said term has lots of benefits, but it only covers you while you work at that job. And the benefit only goes up to your annual salary. What if you unexpectedly pass with your mortgage balance at 150,000, your car note balance at 15,000, and maybe you have 2 kids that are under 18 years old? Clearly, your job insurance is not going to be sufficient to secure your legacy in that scenario, which is why I generally recommend clients with job insurance purchase another term policy and a whole policy. Okay, so maybe you are the VP of a Fortune 500 company, you have a paid off house, you have a paid off car, you don't have a wife, and you only have 1 kid. Then in that case, your executive level benefits package will probably be include a job insurance that is sufficient for you, right? But hold on, there's more. There's something called index universal life insurance. It's also called IUL. And it is the ultimate hybrid. Things you learn as you get older, boy. I'm still learning, and it's fascinating. But the more you learn, the more you can apply it to your circumstances and make it work for you, right? So an IUL combines the death benefit of a term life insurance with the cash value accumulation of the whole life insurance. That's why it's called the ultimate hybrid. The IUL's cash value is tied to the stock market, different stock markets, depending on which IUL purchase. It could be the S&P 500, it could be Standard & Poor, and it has the potential to grow at a much higher rate than the traditional whole life insurance. Yeah. Plus, IUL policyholders can adjust their premium payments and their death benefit coverage to meet their changing needs. That means in the middle of the policy, you can say, okay, I can't afford that much right now. I need to make my premium lower this month or for the next couple months, or I need to increase my death benefit. I just got a new car, and if something happens, I need to pay off that car too. So I need to kick it up like maybe 30, 40,000. It allows you to adjust. That's the beauty of the IUL. Okay, so let's move on. What about my business owners? Any business owners here with tonight? I know there are. So I'm gonna just jump right in. Woohoo! I love my business owners. Well, an executive bonus plan, also called an EBP, uses life insurance like a bank. Woo, beautiful thing, to provide tax-free retirement income. EPBs are like 401ks or IRAs, right? But they have a lot fewer restrictions. So your business is gonna fund it, and it's going to pay for the contributions, and your withdrawals are tax-free, and the money that you put into the plan is tax-free. So it's a legal tax shelter. This is what they're talking about when they're talking about legal tax shelters, where people are hiding their money legally. This category includes a key man and a buy-sell. They cover important, like, key employees and key business owners and partners in the business, meaning like we can't insure under the BPP anyway, we can't insure like the janitor and the clerk, but we can insure the person who is making these custom pastries, and without them, nobody else don't know what's the ingredients in there, right? That's a chef, that's a key employee. We can definitely cover the business owners, because without one business owner, where there's only 2 or 3, a business could fail. Same thing with your partners. So I know your eyes are probably glazing over now. We've been in this webinar for about 35 minutes. So I'm going to take a quick breather here. But the most important thing I want everybody to take away is that I understand buying life insurance can be confusing. So what we did, we meaning my partner, Kevin Donaldson, and I, we developed an online calculator and a quote system to help you figure it out. You can now compare policies from over 70 different insurance carriers on our website, which is realwealthsolutions.com/free quote. Yep, that's it. Leslie put it up right on cue. I love her. That's what you need to be, to like play with the numbers. Go there, start planning your legacy. Choose the policy or policies, right? Because we now know that we need a combo pack to really be secure, that are right for you. And do that from the comfort of your own home. You don't have to set an appointment, walk into an agency, go to the bank, start pulling out papers, or, you know, any of that. You can go into that realwealthsolutions.com/free quote and just play with the numbers, pick different policies, see what the premiums are, see what you can afford. If you're a non-smoker, see what you can get if you're 50, see what you can get if you're 30. Go there, start planning your legacy. Make sure you play with the numbers. If you need help, Kevin and I will be offering free consultations to anyone on this webinar tonight for the next 30 days. So today is June 1st. You have until, I guess, June 30th or July 1st. I'll give you till midnight on June 30th. You call me or email me or text me, right? My number is on the screen, and I will offer you a free consultation to help you go through the process of picking the policies that are meeting your needs, meaning it's going to cover all your debts should you pass away. It's going to feed all your children and your grandchildren, take care of your bills, and then there'll be a nest egg waiting for you. Yeah, for your beneficiary, right? And it won't have to end up in like a GoFundMe to bury you, and then everybody's sad and broke at the same time. Let's just leave them a little sad with some money in their pockets and a future and a legacy. I think Leslie is going to do the same, right, Leslie? You're going to offer.
Yes, I forgot. Thank you, Kiva.
Tell them about that, please.
So, you know, we appreciate you guys spending your Thursday evening before the basketball game with us. You know, this is a tall ask. You guys worked hard all day, and now you're here with us. So as you know, my appreciation is if you want to book a session, a estate planning consultation session, I'm waiving my consultation fee. It's normally $750. So anybody who attends, you're going to get an email following up. There'll be a link that says schedule and a form that you fill out, because when we do estate planning consultations, we want to see what you have, because otherwise I can't really, give advice. I can't see the bigger picture. So once you fill out, it's basically an asset inventory, and send that back to us, and we schedule the consultation, then we can go over everything, and the fee is waived for you guys. So I hope you'll take advantage of that. It's my reward to you guys for spending your hot Thursday inside with us. Kiva, your presentation was awesome. I've got, we've already got some comments. So if anybody has questions, you can either put them in the chat, or we're here. You can unmute yourself. And I'm actually going to turn off the recording because I don't want people to feel intimidated to ask their questions.
Thank you, Leslie. I also wanted to give my partner, Kevin Donaldson, a chance to maybe say a few words, maybe to the thing, if he wants to unmute himself. I'm not sure. Kevin, are you there? Yes.
Can't see myself, but can you see me?
Yes.
So yeah, I great job, Leslie, Kiva, just amazing and so important. Estate planning, I put in the comments, estate planning plus life insurance for businesses and individuals. I love it. It's so important. Kiva's right. We specialize in business life insurance, but also life insurance for personal and individuals. And I think, I don't know, you asked the question if there's any business owners. I'm not sure if anyone raised their hand or anything, but I just go over one thing. If you look at some of the banks, right? And if you ever want to know what you should be doing, look at what the banks are doing, right? So when you look at some of the banks who are publicly traded, and you look at that with the Security and Exchange Commission, you look at their mandatory reportings, a lot of their executives have life insurance, right? Where they're getting hundreds of thousands of dollars of life insurance in lieu of their salary, right? So if their salary, let's say, for instance, is $30 million, maybe they're taking 10 of that million in life insurance. And the reason is because, as Kiva said, they're able to write that off. They're not paying taxes on any of that 10 million, and they're doing so legally. So that's just one of the ways that businesses can take advantage. And I think for individuals, you definitely, as you're building your net worth, you can buy it with life insurance. And I'll leave it with that. Thank you.
Yeah, perfect, Kevin. I love that wrap up. That's key. That's right. I feel so passionate about this now because, like I said, I am not new to law. I've been practicing law for over, oh my goodness, 20 years. I'm not even going to put the number on it no more. I'd make you add my age up. But bankruptcy has now led me into life insurance, and life insurance is opening my eyes to the ways in which people build wealth, at least in this country, right? We're
Eva,
a capitalist society.
Share what you told me earlier before we started about.
Oh my goodness! So I wanted to put in a reading list for the participants on the webinar, but I told Leslie, I said I don't want to overwhelm our participants. This is our first webinar together. It came off fantastic. Thank you so much, Leslie. I think this was a success. But if you get a chance, read "What Would the Rockefellers Do" by Garrett Gunderson. That is the book that literally put a new spin on my financial perspective and opened up my eyes about what life insurance can be in terms of a tool in your toolbox to build a legacy. And that's what we need. I don't know if that's what you were referring to, Leslie.
No, the bankruptcy stuff.
How could I forget? I know. So bankruptcy is so every day to me that I forget sometimes how special it can be in certain situations. So what I was telling Leslie, and this is probably my wrap up as well, is that bankruptcy allows you to keep your life insurance policy and wipe out your debt, no matter how much of your policy you have. So if you have 5, 6, 7 policies, and maybe those face value amounts on those policies add up to $1 million, 10 million, 20 million, a bankruptcy trustee cannot seize that policy to pay off your debts. It is 100% limitless protection on your life insurance policy when you file for bankruptcy. I take it for granted, but now that I learn about life insurance, I'm like, yes, that is key. No matter if you have put away all of your pennies into your policy and built your legacy from the scratch up, and you get it to the top of the mountain and you end up in a place where your debts are overwhelming you and your income is not enough to cover it within a certain amount of time, you shouldn't be paying on credit card bills for 2-3 years, by the way. But if it's taking you that, remember, you have the option to wipe it all out and keep your life insurance. There's nothing better than that. Because literally, like I said, that could be a $10 million asset. If you had a $10 million vacation home, definitely believe the Chapter 7 trustee would be going after it to cover your debts, but they cannot go after any policies. And that's a beautiful benefit. And another asset strategy in terms of building up your legacy with things that cover you all around. And I'm definitely hope you guys take advantage of that free consultation offer that Leslie gave, because you're going to need it. If you have children like me, and I have grandchildren too, so we need it. And you need to get on board with that and get in touch with Leslie. That is a huge discount she's giving you. $750 is not peanuts. My hourly rate is $350. So you're getting a $350 deal with me on life insurance consultation, but you're getting a $750 deal from Leslie on the estate planning. So it's worth it. I say get your appointment set sometime this week or next week, and don't wait until the end of June when your special runs out, because don't call me on the 4th of July talking about, Kiva, I want my free consult. I'm gonna say, you're expired. No, I'm not. I'm just joking. I'm much kinder than that now. But I love you guys for joining us, and I want to say thank you, Leslie, for your beautiful presentation. Everybody is texting me now telling me how much you were so enlightening and so informative. Have to do this again.
Great. I'm going to stop the recording and then again to open it up for
good. But we'll be doing this again for anybody that missed a portion of it, or we're going to do it maybe every quarter or so. I'll talk to Leslie, we'll plan it, and you'll get what you need always. So thank you for joining us tonight. Leslie, if you want to say anything, I'm done.
Yeah, just I did stop the recording. So, I know usually people have questions. So whether you have insurance questions or estate plan questions, please feel free to, put them in the chat and I'll read them, or unmute yourself. We'll give it a few minutes, and then if not, then we'll just end early. And I hope this was informative for people. So I guess no questions. So if people want to go watch the basketball game, I think. So
got a question.
Okay, please.
Hey. So I feel like I don't know if I read something or somebody told me. But as far as like when it comes to like trust, collectors could come after stuff that's in your trust, right?
Right. So there's two types of trusts. What I talked about today was the revocable living trust. And I said, with the wagon, if I'm in control of it, a creditor can come after it. If I can write the checks, a creditor can come after it. The other option is an irrevocable trust. And that's where you put the assets in the trust, but you immediately give the control to somebody else. So we usually do this when we're doing elder planning for Medicaid purposes. We want mom and dad to be able to go into a nursing home and not have the nursing home attach a lien to the house or the bank accounts. So we move those into the irrevocable trust, and mom and dad no longer have control of those assets. So the child, the daughter, the trustee now has to manage the assets for their benefit, and that gives them the creditor protection. We call it an asset protection trust. So thank you for asking that. That's a really good clarifying question. So the way you could think about it is, if I'm in control of my trust, if I can write a check, a creditor can come after the asset. But if I don't have control of the asset, I don't have control of the trust, it's protected.
Gotcha. I got another question.
Sure.
Are there cases where someone may have like multiple trusts and maybe not just?
Yeah, I mean, where we start obviously is the basics. We try to set, especially depending on age or family circumstances, but you might create a special needs trust. Sometimes that could be in a trust or standalone. So if you have a child or a family member that has a disability and an inheritance would affect their benefits, then we would create a trust for them. There's life insurance trust, which would be like a whole nother topic with Kiva, where we usually see that is when somebody is at risk of the estate tax. And so that right now there's an estate tax exemption. There's a federal and a New York exemption. So as long as your assets are in New York less than, I think it's 8 million, the numbers I'm blanking on the number, and 10 million, then you don't have to worry about the estate tax. But if you have more than those assets, the family would have to pay an estate tax. So there's additional trust that can be set up to help avoid the tax.
Interesting. Thank you.
You're welcome. Thanks for asking.
I actually have a question. I'm curious to know about what type of policy or how you would go about, I guess, protecting things like stocks, stuff that continues to grow way after you do die, but you want somebody to be able to have access to that asset.
Okay, you're talking about for estate planning. That's not an insurance question, right?
I don't know. That's why I'm asking basically about stocks.
Yeah, no, that's not really an insurance question. She's saying she wants to try to protect her stock portfolio. Is that something that the trust can control? That's a good question.
Yeah, exactly. So there's a couple ways to do it. So the first one would be, obviously you could transfer the account out of your individual name into the name of the trust. So therefore the trust owns that investment account. And then you as the trustee are managing it while you're alive. And then whoever you appoint as a successor trustee would then manage it after you pass away. So a lot of times we'll see, for example, a parent will name guardians for their children. They'll name who they want to raise the children, but those people aren't necessarily financially savvy and know about investments. So they'll appoint a separate person as the trustee. That person manages the money and pays for the needs of the children separate from what the guardian is doing raising them. So yeah, so it's all about, you can pick who you want. You can pick a corporate trustee if you wanted. And yeah, that way your investments continue to grow for the benefit of your beneficiaries, your loved ones.
So just to clarify, basically any type of asset, whether it continues to grow, whether you're alive or dead, it all needs to go into the name of the trust and take everything out of personal accounts, basically.
Right. Now you can leave some, thank you. I meant to say this. So you can also leave it in your name. And then what you would do is the beneficiary would be the trust. So you can still control it in your name. And then when you pass away, it'll have a payable on death or transfer on death beneficiary. And at that point, the beneficiary would be the trust, and it would have the same effect as what we just talked about. The difference being some people need their trust to go into effect while they're alive because there's an incapacity. So the payable on death beneficiary only works upon death. But if you had, you're managing your funds and something happens to you and you need someone else to take over, nobody else would have that authority unless the trust owns it. So, it would be a conversation you'd have with your investor or the people managing your money. Are you allowed to transfer the asset to a trust? And then if so, you can decide whether you want to leave it in your name and have the trust as the beneficiary or transfer it entirely to the trust. And then Kiva is also saying the owner of a life insurance can be a trust too. So yes, so you have the flexibility if you're going to buy life insurance, not just to own it as an individual, but also your trust can own it.
Okay, I think I have a young lady by the name of Christina Harvey on here. She has a question. She's a little shy to speak, but I told her go for it. So Christina, if you want to, you can go ahead and say something. Christina Ortiz Harvey.
Thank you so much, Kiva, and hi, this has been amazing. Actually, right now I'm just digesting everything. Someone actually asked a question. I was thinking about the special needs trust. I've only heard the term. I have no idea what's involved in it. I am just kind of digesting it for the special needs trust. Can you have multiple trustees? I may have missed that piece. Can you have multiple trustees if I wanted to appoint 2 people to be part of the trustee for someone who's special needs?
Yeah. Yeah, that's a good question. So, trusts are basically a legal contract, and you can modify those according to your wishes. So again, this is another reason why we don't recommend those online download a trust, fill it out, sign your name, because they're not a one-shot deal. They need to be customized to families. So some people might want co-trustees, right? Like I have two siblings and, they both should be making these decisions and they work well together. And so we want co-trustees, and there's like an accountability thing there. Some people are like, there's no way I could name co-trustees, because if one doesn't agree, nothing can get done. They both have to sign that check. So, it's going to depend on the family dynamics and, what's your preference. I've seen, we'd had a case where there was 3 co-trustees. I mean, these 2 brothers and a sister. I was like, this is going to be a nightmare. I can't imagine. They worked so well together. It was beautiful. I wish every family could do that. The 3 of them had to agree on everything, and they did. So it can definitely work. You can definitely have multiple trustees. So as long as it makes sense for your family, then yes.
Thank you.
Sure.
Thank you, Christina. It is now 7:55, people. We have to take a breather. I love the fact that so many of my family members are on here. I love the fact that our colleagues are on here. And most of all, I like the fact that Leslie and Kevin so graciously agreed to do this webinar with me. As you can see, Leslie is a wealth of knowledge when it comes to estate planning. So like I said, I hope you guys take advantage of her free consult offer. You can reach out to myself or Kevin, or just log on to realwealthsolutions.com and just play around with the life insurance portion of your financial portfolio. And I hope that you all will log back on with us for future webinars, because there are always emerging issues when it comes to planning your legacy. So you need to be aware of the hot topics and how to handle it and how to pivot and be empowered by what you learn. So hopefully you feel like that right now. That's how I feel. I feel empowered every time I talk to Leslie. So I know you guys got some of that magic. Thank you for being here tonight. Leslie?
Thank you
I have
again.
a quick question.
Mm-hmm.
Will we have access to the recording of the webinar?
Yeah, I don't send it to everybody, but you got the email link. So just email me or any of the emails you got from us, and we can send you the recording.
Okay, thank you.
You're welcome. Cool. Kiva, thank you so much for having me. This was great. You're a wealth of knowledge too. So I look forward to doing more of these. So if anybody has suggestions, what do you want to hear? Let us know so we can tailor it to, what you guys want.
That's a great idea. Thank you so much, guys, for being here. That is a great idea. Shoot us some ideas about specific things that you want to know, so we'll know how to tailor it even more perfect next time. But this was great. I feel really good, and I know you guys do. So thank you for being here with us tonight, here where we honor virtue, here where we benefit from gratitude, and here where we are at peace. Yes?
Yes.
Thank you, and good night.
Thank you, Kiva.
All right, darling.
All right.